Good evening, ladies and gentlemen. So over the last few months I've done a series of videos on the demise of one of the internet's most controversial media companies, Gawker Media. Throughout these videos I've traced the various financial dealings and corporate structure that Gawker and their founder Nick Denton have set up over the last few years to essentially avoid a bunch of tax in the US. However, the one thing that my coverage of Gawker and their machinations has always lacked is this: hard evidence. And thus so far I've had to function on guesswork and what little publicly available sources I had to go on. Fortunately enough, this time is somewhat different. Thanks to an anonymous source, I've managed to gain access to 8 years of the financial records of Gawker's Hungarian subsidiary, Blogwire Hungary, aka Kinja KFT. So the lion's share of this video will be going through and analysing some of these financial statements to show how the Gawker Media empire really ran. But before we can get to that, we have to first go over where Gawker is sitting as an organisation today. So when I last left off, Gawker had just been found guilty for the sum of $140 million in the favour of Hulk Hogan, and was staring down the barrel of bankruptcy. Well, since then it has transpired that the man who funded the entire Hogan legal trial to the tune of $10 million was Peter Thiel, a Silicon Valley billionaire who I mentioned in my very first video, who Gawker outed as being gay on their Valleywag blog in 2007. Following this revelation, there's been much controversy around Thiel's actions, with some in the media suggesting that this has set a dangerous precedent for press freedom, though of course the validity of their arguments and whether or not they are making these from a position of conflict of interest is of course a matter of public debate. As for Gawker itself, it declared bankruptcy in May in order to stop Hulk Hogan from collecting the judgment, and so as a result all of the business assets had to be auctioned off. Gawker chief Nick Denton also filed for a Chapter 11 bankruptcy on the 20th of July 2016, though the bankruptcy protections for him from the $120 million which the court found him liable for were ruled as being temporary while the bankruptcy is sorted out with Gawker. Furthermore, as of the 8th of August 2016, there is talk of a settlement between Hogan and Gawker. However, the long-term effects of such a deal aren't known at this point. The auction of Gawker's assets then went ahead on August the 16th, 2016, which ended up with the assets being sold to Spanish language TV network Univision Incorporated for $135 million. They own, among other things, The Onion and Clickhole. It was then announced on the 19th of August 2016 that the main Gawker website was going to be fully shut down, though the associated properties like Kotaku, Jezebel and Deadspin will remain open for the foreseeable future. And so that's about where the organisation is sitting. None of the original management own it, and the individual properties have been sold off. Now, before we move on to the new documents, it's going to be best to go back to my last video on Gawker and discuss how their corporate setup basically worked. So Gawker has a top-down structure with three main entities: Gawker Media Group, which is the Cayman Islands parent company, and that owns Gawker Media Limited, which is their New York-based subsidiary which employed all of their staff and conducted all of their writing and such business. And then Kinja KFT, which is also owned by Gawker Media Group, which was an obscure Hungarian company that holds intellectual property rights and charges license fees back to the US company, in an arrangement that I pointed out is a very common method of reducing a corporation's tax bill. This works because any of the income that the US company can export to Hungary would be taxed at 10%, which is Hungary's corporate tax, instead of the 35% corporate tax that they'd have to deal with in the United States. Now, bearing that in mind, the documents which we have to examine here are the complete financial statements of the Hungarian subsidiary for the years 2008 up until 2015, which were given to me by an anonymous source, as I said earlier. These documents, when taken with some of the previously leaked documents, paint a more clear picture of the function and purpose of Kinja KFT when they are analysed, and show how the impending Hogan lawsuit, among other factors, possibly possibly changed the entire financial structure of the Gawker Media operation as a whole. So where to begin? Well, it's probably best to start with the description of the business and what it does. So Blogwire Hungary Kft. Was founded on October the 1st, 2002 at an office in downtown Budapest. The director of the company was initially one Julia Huszar, occupation unknown, who managed the Hungarian firm from its initial founding years up until 2013. The company's industry classification was intellectual product recovery, which would support the idea that it was initially formed as a shell company or a holding company to hold on to millions of dollars in Gawker intellectual property that could be licensed back to the United States company. However, in 2013, the year that the Hulk Hogan lawsuit was lodged, a number of structural changes occurred at the Hungarian firm. On the 30th of April 2013, name change papers were filed officially changing the company name to Kinja Kft. The company also got a new director by the name of Peter Sager. The company's industry classification also changed in 2013 dramatically from being just intellectual property recovery to covering a wide range of industries and services. Now, it could of course be mere coincidence that all of these changes took place, but as we go forward, we're going to see this very clear pattern emerging. So what we're going to do next is look at the financial data we have from the company, in particular some key figures from the financial statements from the years 2008 through to 2015. So there's quite a number of key points of interest to note about the way in which the company worked during these years, and so we're going to proceed through the information looking at trends in each key figure over time. So let's begin with our first item of interest, labor costs. In particular, Blogwire paid 0 to employees in 2008 and 2009 and only about $4,000 to employees in 2010, which indicates for all intents and purposes that there was very little actual economic activity at the firm during this period, which is consistent with what you would expect from an intellectual property holding shell company. However, from 2011 forward, staff costs began to increase steadily, with 2011 posting $143,000 in wages and 2012 posting almost $300,000 in wages. It isn't, however, until 2013 that labor costs jumped up to over $660,000 and then peaked at over $1.3 million in 2014, and by 2015-2016 they were paying $1.2 million in labor costs, and according to one source, employing 30 staff, which would average out at $33,000 each. Now, by themselves, these figures aren't suspicious, but they do show us a massive escalation in economic activity, especially past the 2013 date. This brings us to our next port of call, sales. Now, the majority of the firm's revenue is made up through sales of its services. These sales are classified into two types: domestic sales and export sales. Up until 2012, all of the sales made through this company were marked as domestic sales. However, from the 2013 financial statements onwards, all of these sales were suddenly being marked as exports. Now, why this is unknown at present, but it's yet another change that occurred in 2013. As for the numbers, they show a steady increase over the period, which is generally what you would expect with a business that is ramping up economic activity. It should also be noted that the majority of the sales made came from service fees paid by the American company. This is provable through cross-referencing the Gawker tax returns to the new documents, which revealed that at least for the years 2011 through 2013, Gawker US was responsible for on average over 70% of the Hungarian firm's sales revenue. This brings us further to the assets used to generate the revenue. Now, the assets of the company are probably the most complex part. In the early pre-2013 era, most of these holdings were intellectual property, which were fixed assets and intangible assets, and they would have a moderate amount of trade debtors, which are people that owed them money. Pretty standard asset base. However, from 2013 onwards, a new complex form of assets started appearing on their books. Basically, the US-based Gawker company started buying the range of services which the Hungarian company were now offering on credit, boosting the company's sales and assets at the same time. This is reflected on the graph of the firm's total assets for the 2014 and 2015 period. Now, what this large increase in credit sales really means is hard to say, but it's clear that the US-based company all of a sudden began to owe a large amount of funds. The other main asset to keep track of is of course how much cash the business had in the bank. The bank in question being an American bank, Silicon Valley Bank, which is used by large technological companies. From 2011 forward, however, there was a huge swell in cash held at the company, which mysteriously all seemed to disappear in 2014, going from 5 million in the bank down to 100,000 in the bank in the space of a year. The money, according to the book, seems to have been spent largely on the acquisition of fixed assets to the tune of $3.6 million, which was spent on quote-unquote intangible assets, though it's not clear what these are. However, if these intangible assets were bought from either of Gawker's two other companies, they would be a good way of freeing up some cash for something like a protracted legal battle, for example. On the other side of the balance sheet are the liabilities, aka what the firm owes. These are composed entirely of short-term liabilities, aka people that they bought things from that they now owe. However, the liabilities are mostly made out of quote-unquote other short-term liabilities, which makes it hard to say who exactly the money was owed to and for what. The only other potentially odd thing with the liabilities is the total lack of any long-term loans, so they didn't take any money out from, say, a bank or something to finance their operations. This says that the company was able to self-finance with the revenue generated and they didn't need outside finance, but its significance is once again quite unclear. Furthermore, there's the matter of net profit after tax to consider. Net profit after tax is simply the sales revenue minus all of the expenses and then taking off the Hungarian corporate tax of 10%. The main thing that is somewhat perplexing in the financial statements though is that once again 2013's number makes very little sense because the net profit for the year is in fact higher than the sales revenue, which is quite an unusual situation. And there doesn't seem to be an obvious explanation in the statements themselves, though they are linked down below for public scrutiny. And the final piece that we have, which is where hopefully all of this should make more sense, is the dividends paid out to the company's owners and the retained earnings account. So firstly, what are dividends? Well, put simply, dividends are money paid out of a company's profit to shareholders to reward them for holding the company's stock and to encourage them to keep holding it. In this case, there's only one shareholder, the Cayman Islands company Gawker Media Group, which was being run by Nick Denton. This will be important going forward. Now, what are retained earnings? There is simply all of the profit that is left over at the end of each year once you have taken the dividends paid out off. And then this money is usually reinvested back into assets to keep the company going. So when you look at both the dividends and retained earnings over the years at Kinja KFT, you start to see a very clear pattern. For every year from 2008 up until 2012, just about 100% of the earnings that the company made were shipped out to the Cayman Islands parent company as dividends for owning the stock in the Hungarian company. And they did that all the way up until 2013, when all of a sudden they stopped paying themselves out altogether. Now, why I think this is, I'll touch on later. As dividends stopped being paid out to the Cayman Islands, of course, that meant that the retained earnings of the firm just kept building and building up in the business, and these funds were probably used to buy more assets as previously shown. So then, what does all of this mean? Well, to wrap up, I'll simply give my opinion about what we've examined here. All of the documents are translated down below, so you can look at all of these on your own time and come up with anything else that I've missed. In my opinion, this look into Gawker's finances shows two clear periods of this company's life. In the first period, running from 2008 up until 2012, was when Blogwire Hungary was essentially a shell company. The low labor costs in the early years years attest to this fact. And so what was the purpose of the shell company? Well, simply, in my opinion, to take in service fees from the US company and convert them into dividends. Why dividends? Because under US tax law, and given what Denton was earning from the US company through his tax returns, these dividends, provided some of them found their way into Denton's pocket, would only be taxed at 15% instead of the 30+% that he would normally be paying in the States. And so that makes a compelling and totally legal reason for why the company was operating how it was. However, as we saw in the numbers, 2013 was when it all changed and the dividends stopped flowing out of the company. This was the year that Hulk Hogan also lodged the lawsuit, and also the year that the US tax code changed to increase the taxes on these dividends to 20% given Denton's income for that year. However, there was another event that happened in 2013 that also affected the company, and that was when Kinja launched its blogging software on several of Gawker's websites, and this software was subsequently licensed and used across the Gawker network and maintained by a team of engineers who were living in Hungary. Now, if we bear in mind that this company that developed the software didn't actually have any staff employed until 2011, then it took under 3 years for the software to be developed, which led to major changes at the company, and so the company was basically taken from being a shell company to being legit past 2013. Money was then left to build in the company until they could afford even more assets and until it became a viable entity of its own. So then, why do this? Why invest all this capital in this business past 2013? Well, given the way things have gone, I have my own personal theory, and that's that Nick Denton poured capital into this business as a backup plan in case they lost the lawsuit, because if things turned out the way they have now, then at least he would still have this technology which he could sell and a viable business tucked away halfway across the world where no US based lawsuit could get at it. Now, I should point out that none of that's illegal, it's just quite creative, but that's just my theory. All of my facts are down below where you can make your own conclusions. Of course, whatever the machinations were behind all of the moves here, this matters very little in the end, because as according to the official purchase agreement, Univision now owned this company, Kinja Kft. In Hungary, and will be dissolving this company as soon as the Chapter 11 bankruptcy case against Gawker is resolved. And so with that, we close the book on one of my longest running video series of all time. As per usual, full sources are down below so that you can look at all of the information yourself and form a balanced and sensible opinion. Only time will tell how Denton's passing from the online media establishment will impact how business is done, if at all. I've been Dangerous Analysis. Thanks to my patrons and subscribers, and as always,
good night and good luck.